Hello, am I audible? Hello, am I audible by any chance? Is anyone there?
Yeah.
Okay, thank you. We'll just wait for a couple of minutes before we start this session.
Perfect.
By any chance, can anyone confirm whether my screen is visible to you guys?
Yeah, I can see it.
Okay, thank you. We'll just wait for another minute and then we'll kick it off. Okay, good evening, everyone. I'll be the trainer for today's session on Introduction to Investing. So, my name is Kushraj, and I've been roughly been in the stock market for now 5+ years. I started investing back in when I was around 18 years old, and for the past almost 2.5 years, I've been a regular day trader. I've been trading on equities as well as derivatives. I've been trading on commodities as well as currencies. So I've come a long way, but I believe it's a long way to go even further. It's because investing and trading is one such thing that no matter how experienced you are, it will give you a surprise one fine day and you will be back to the ground. So this something investing and trading will always require you to be on your feet. You can't really take it for granted, or it will show you your right position. So this is a warning, but don't worry. I'm here to make it easy for you guys, to not make you scare away, but to teach you and make you comfortable with it. So to start off, I would like this session to be really interactive so that it could be good for everyone. So I just want to throw out this question over here. Love of money is the root cause of all evil. So how many of you guys agree to this statement? Love of money is the root cause of evil.
Agreed.
Other people? I'd encourage you to speak up right now.
Yeah, I agree as well.
Are you sure? Love of money is the root cause of evil.
Uh, More like uh, not necessarily love of money, but uh, I don't know what to call greed, but I guess that's way above love. Yeah.
Okay, fair enough. Anyone else wants to add on something by any chance? Okay.
I think it's how you look at it, right? It can be two aspects of it as well. Sometimes the love of money can drive you as well, and that's not necessary evil.
Okay, good stance. Look at the second statement. Lack of money is cause of evil. How many people agree to this one then? Love of money or lack of money? What do you think is the cause of evil?
I don't think it's either of them. The statement as such cannot. It's too broad to apply to everybody that's considered evil.
Okay, pretty diplomatic a stance. Anyone else wants to give it a shot?
I think lack of money would be considered a more concrete evil, according to me, because it just life gets a little bit more complicated when there is a lack of money in comparison to when there's love for it.
Okay, so fair enough. Like there can't be a straightforward answer to this. It can be either or. It's really on the two extreme sides of thing. So you can't really pinpoint on one state and be like this is the concrete truth. But it all depends on how you look at money, how you look at investing, how you look at what you really expect. So that brings us to the next thing. Is greed good?
I would definitely say greed is bad.
Greed is bad. Okay.
uh, but it's not just about money. Greed in general is something that causes people to act out. Is what I feel. So that's a personal opinion, though.
Yeah, yeah, you can of course share your personal opinions. It's fine. So is greed good, Rohan?
Greed, greed in general, I don't think it's a very positive word that could be used. But yeah, you need to be a little greedy at least, like to basically continue having that drive. Otherwise, if there's no greed involved in there or there's no push, you're not really going to achieve much.
Interesting concept. You're talking about the push that you need to achieve things.
Yeah,
So
yeah.
this brings me to the next thing. Take it from me, greed is good if only you can afford it. So if you're greedy to be making money, which is fine, you should be looking forward to making money. But if you're looking forward to make 10 grand or probably 100 grand, then you should also be prepared to lose out on that 100 grand or that 10 grand because things can go wrong. So if you're ambitious enough to be willing to make that 10 grand, you should also be able to afford losing that 10 grand. But i- given a position wherein like you have only 10,000 in a savings account and then you're like, okay, I want to make 10,000 on this. So you can't really afford to lose out on that 10,000, can you? You can barely afford to lose out on 1,000 or 2,000 rupees. So your greed is only up to 1,000 or 2,000. So this is where it comes, wherein you draw a limit. Okay, I'm in the market for this much return, and this is what I'll be willing to lose in return for it if things go wrong. You have to draw a line, or else greed will take you places, and those places you don't want to be in. So greed is good if only you can afford it. Are we comfortable with this now?
Yeah.
I
Like
think it's fair.
yeah, like Rohan rightly said, you need a push. More often than not, if you aren't greedy to achieve something, then you're at square one only. You won't be moving ahead. You need that extra zeal in you to go forward. But then that zeal should be something that you can actually afford to go that much forward. Because of course we've heard like more the risk, more the return. But what we forget in this that the risk is something that is omnipresent and things may go wrong. So even though you look forward to returns, we often forget to think about the losses that may occur as well. Now, coming to greed relating to it, how much return do you need? So, Ron, how much, if you, let's say, if you have 50 grand, how much return do you need on it?
uh, how long would you want to like spread this upon it based on that, right? Like if you're looking for like a high risk thing, your return will have to be more as well. So that 50 grand, if I'm putting it into a high risk thing, I'd want at least like 20 to 25% more. If it's
Okay,
little less riskier, like 5 to 10% would be good as well.
okay, 5 to 10%
Uh,
return, 20 to 25% on the higher end. Anyone else? How much returns do you guys need?
uh, we would obviously want a higher return, but then normally this is tied to the duration in which we expect the returns. And right, I mean, anything that gives you a high return in a very short duration is too good to be true, if I'm not wrong.
And that's one way of putting it. But if you actually interact with a regular derivative day trader, they'll tell you in the short run there is money, in the long run there is no money.
Oh,
So
okay.
so in derivatives, what happens is you're with only 1 lakh rupees, you can be trading on some worth 50 lakh rupees. So these are some things called margins. So margin
Okay.
is something as simple as like 1 lakh, if you have, that is your security. So in 1 lakh, the broker will give you 50 lakh, for example. That does not happen really, but I'm giving an example. They'll take 1 lakh of yours as cash and give you 50 lakh. So that 1 lakh is as your guarantee,
Yeah.
and that 50 lakh can be used to trade, and those 50 lakhs can reduce to half in half an hour, or probably be double in half an hour. And if you leave it for the long term, if you leave it for a week, also in derivatives a week is considered long term, you will be incurring losses, because derivatives are something that change really frequently by the second, like high amounts of volatility in seconds. So term, when you're talking about the term, when it comes to trading, it really depends on the instrument that we're talking about. Not all instruments are long term instruments. Some instruments are extreme short term instruments as well. So how much return do you need? Someone said 25%. Let's talk percentage. Who wants more return, guys?
Okay, if that's the scenario, then I guess it's fair to expect 100% return. I mean, greed is
Okay.
good after all, right?
Yeah, but can you afford to lose out on your 100%?
That's a good question, actually. Okay, let's be safe and say about 25 to 50.
25%. So
But don't you think that if you're looking for that 100% gain, you would not want to invest 100% of what you have? Like, okay, fine. On the 50% of the money that I have, if I invest that, I'd want to make double the gain. But so I wouldn't put all my like balls in one basket, basically.
Uh,
yeah, you
Fair
might
enough.
not. Yeah, you want to answer this, or you want to add on
No, so
something?
no, I thought that was I personally wanted 100%, but then you said I should be prepared to lose that 100% as well.
Hmm.
So I'm ready to invest that 100%, but I'm not prepared to lose it. Which is why I said, okay, maybe if the boundary has to be drawn somewhere, then I guess 25% is what I want, so that I'd make an equal loss if I'm not taking a profit.
Uh-huh. Good enough. Okay, so one thing I forgot to ask you guys, how many of y'all are already into investing? How many of you guys have invested in some form or the other? Even a FD is fine. Like, we are just having a short discussion over here.
I've been investing for 2 to 3 years. I'm actually working in the field of investing a while ago, and then I'm now switched to marketing. So, but then I don't do stocks, equity. I mean, stocks and derivatives. I do mutual funds.
Okay, good. Anyone else?
This is a very new topic for me because I'm just pursuing my engineering, so I really have no idea what is investing in. Like, I've just seen it from a very long distance, but I've never applied it somewhere.
Okay, so are you aware about simple concepts like fixed deposits?
Yeah.
Okay, good. And anyone else wants to answer, wants to volunteer to contribute to the discussion? Okay, so when we talk about in investing terms, how much return do you need? Ideally, it should be beating your personal rate of inflation. So, personal rate of inflation is a concept that we often use in investment planning. It is as simple as how much money you spent marginally more compared to the last year. In this year, how much you spent more compared to the last year. So, for example, all your expenses total up to say 10 lakhs in last year, and this year you've spent about 15 lakhs. So there has been an increase of almost 50% in your rate of inflation, personal rate of inflation. Your expenses have gone up by 50%. So when you're talking about investing, for example, if you've invested 10 lakhs, you would want to get 15 lakhs back. That is how you meet your expenditure. Of course, things like prices of things grow year on year, or probably in India it grows year on year. In some countries it may decrease year on year as well, but when we talk about India, it always increases year on year. So your expenditure is gradually going to increase over a period. So your investments should give you returns in line with your increase in expenditure. Now, of course, you may have exceptional scenarios wherein you would want to buy a car or probably get married and settle down. Or probably you're expecting a child and you are worried about that child's education. So there are various wealth management products which help you to achieve these targets, which I'll be coming to later. But when you're talking in a normal scenario, it should be beating your personal rate of inflation. So are we clear on the concept of personal rate of inflation?
Yeah.
Yeah.
Okay. So now investment versus trading. So I heard there's a engineer in here. So this would be really idealistic for you. You would get a glimpse into what is the difference between the two, because usually what happens is that these two terms are synonymously used with each other, but that is actually not true. It's very different from each other. So trading and investing. Trading is usually in the short run. Investing is a long-term gain. Trading, the costs are higher, investing costs are lower. So when we talk about cost is essentially over here the brokerage that you pay. So when you're trading happens day in, day out, week in, week out. So the more you trade, basically the more you buy and sell, the more brokerage you will be incurring. Brokerage is something that a broker will charge you in return for the services. And in investing, essentially, you're just buying, say, shares once and then leaving it in your account for 5 to 6 years or probably more than that. So you're not going to be incurring any brokerage here, other than the one time you bought it and the second time you sell it, which is going to be after a couple of years. Risk involved in trading is high, and investing is relatively low because you're buying and selling almost day in, day out. You're taking the risk every day, and it's a short term. Risk is always higher in the short term. So there's a curve of risk and time. So in the short term, risk is always high. Whereas in investing, risk is low because it's believed that in the long run, everything will gradually increase with the rate of increase in inflation. Because inflation is increasing, so your returns will also increase with it. Returns. In trading, it could be anywhere between low to high, and in investing it's believed to be higher. So trading, there's no exact bandwidth like what you can see in the graphic on your screen right now. It could be anywhere between low to high, or it can also be negative like what it could be what's mentioned over here. Taxation. So trading, it invites short-term capital gains tax, which is right now I think 15% or 10%. 10%. And if you're talking about derivatives, they invite speculative gains tax. Whereas in investing right now we have a new legislation which says that anything any gains above the amount of 1 lakh in a year will be taxed at 10% per annum. Before 2016 there was no long term capital gains tax. So any gains you have over a year, so for example you're holding a share which you've kept with you for more than 365 days, so that wouldn't invite any taxes when you sell those and make a gain. But right now, if the amount is more than 1 lakh, so whatever is more than 1 lakh you will be taxed 10% on it. So long term in equities is 1 year. That is the classification how something is considered as long term in terms of taxation. Are we clear on this slide? Any doubts, any questions?
No, no questions.
I'll be moving on to the next one. So these two people, Warren Buffett, he is known as the Oracle of Omaha. He is one of the most renowned investors around the world. So he is one of the major shareholders in the company Apple. He owns this own company called Berkshire Hathaway, which also has a majority stake in this company called Heinz. Heinz is the tomato ketchup company. It also makes jams and other agro-based FMCG products. So Warren Buffett, he is known to be the father of value investing. So what Warren Buffett says is that before he invests his money in any given company, let's say Apple for example, so he spends at least 3 to 4 hours reading the annual report of the company. So by law across the world, every company that is listed on a stock exchange is required to produce a annual report. So what annual report essentially contains is every strategy of the company, what the company is into, who are the managers of the company, what is the board of the company, how much cost is the company incurring in making their products, or how much marketing costs are involved, how much advertisement costs are involved. Everything is reflected in the company's annual report. They also mention about what are the future plans of the company, how are they planning to grow, and they also include competitor strategy, how they are performing against the competitors, who is the major competitor. So essentially you get the entire history geography of a company from the annual report of a company. So Warren Buffett's ideology is you should read everything about the company before you enter into an investment. Coming to Rakesh Jhunjhunwala. So Rakesh Jhunjhunwala, as you can see, he's an Indian. He's known as the big bull of India. So Rakesh Jhunjhunwala is one of the largest investors in India, and the Indian markets essentially move as per him. Like there have been multiple cases over time wherein he has dictated the markets because he is such a big name in the investor world. Once what happened in 2017, there's this company called Amtech Software. So there was news that came out in the market is that Rakesh is rapidly increasing his stake in this company called Amtech, and within a period of 1 month that company grew 80% because people heard that Rakesh is investing in this company, so they automatically joined the bandwagon and the company grew like anything. So in India, we have such kind of bandwagon effect because our markets are yet in the developing stages. It is not as matured as a market like an American market or the European markets. So things like these tend to dominate the market in its directions. Another great example relating to Rakesh is that his one of his favorite companies has been Titan. Titan is the watch company owned by Tata Group. So Rakesh has always he's publicly admitted that it's his favorite company. It's always going to be in his portfolio in some percentage or the other. So I think in this week only a news came out that Rakesh originally owned about 6.8% of the company, 6.6% of the company, and he sold more than 1% stake in that company in a given month. So he reduced his stake to I think 5.4 or something, and the shares automatically fell around 10 to 12% with this news itself. So if you get a news that okay, like Rakesh is buying a company or selling a company, you can imagine which direction that company may go to. So current market scenario, like we are in the midst of something that you may experience once in 10 to 15 years only, and it could not be a better time for you to enter the market right now because markets have fallen so much. Everything is available at a discount. Good companies are available at a discount. So current market scenario, I've quoted an example from Germany's per capita GDP. So you can see Germany before the World War One and World War II, and after World War II. So there's the red dotted lines is the trend line of 1914 period, basically before the World War One, and you see during the two wars, the per capita GDP has fallen tremendously. But with time, with around 20 to 30 years, it has grown back. It has gone even further upwards, and now Germany in today's time is one of the most dominant economies in the world. So what I'm trying to say over here, in the short run, things may go down, but whenever things go down, they bounce back up even tougher. They go to newer heights whenever they go down to lower lows. So there's a concept in investing which they often quote. The lower the lows are, the higher the highs will be. So if the stock markets are going lower at 10-year low, then probably they'll be hitting the 10-year high within a period of 1 to 2 years and gonna go even further. Interestingly, someone did a research on the top 100 stocks in USA rather, and they came up with these statistics. So stocks have declined at least 10% 95 times in a year. That's about 11 months on average. Stocks have declined at least 15% 44 times. That's about every 2 years. Stocks have declined at least 20% 22 times. That's about once every 4 years. and at least 30% 9 times, that's once in every decade. So this is like one of the scenarios where you can see like the last time stocks had fallen so much was back in 2008 2009, and now it's 2020, almost a decade later, the stocks have fallen more than 30%, and stocks have crashed at least 50% 3 times. This will happen maybe twice in your lifetime. So this study was done on the 100 top equity shares of USA, and these are the results. So there are a couple of shares even in India which have fallen rather more than 50% in the given time. And if the company, like if you have time and you get time to read the balance sheet and the annual report of the company, and if you feel that company is something that has matter, has substance, and it has fallen 50%, then you've probably identified a gold tunnel for yourself, gold cave for yourself. And right now the equity markets are of course down, as we guys know. There's a lot of news out there. So even if you just start investing in a mutual fund, for example, you can expect good returns within 2 to 3 years, and of course in the long term you'll be getting even more returns because you have entered at such a period. And also one more thing, so basics of making money in investing is you buy at a lower price and sell at a higher price. It could not be more simpler than that. It can't be put out more simpler than that. You buy at a low price, you sell at a higher price. You buy at 100 rupees, you sell at 150 rupees, and that's how you make your 50%. So right now sh- almost all shares are down, and if you can identify a good share, for example Reliance, or for example say ITC, or say let's just say Bajaj Finance, and those shares are pretty lower, they are available at very lower cost right now, and those shares could go up almost 50% in the next 2 to 3 years. Now investment avenues, so there are multiple avenues available for you to invest in. I'll be discussing all the ones. Firstly, put forward debt. Anyone wants to take a shot? What is debt when we are talking in terms of investment? Anyone?
Uh, okay, based on my knowledge, normally they're government bonds and securities which have come at a very low risk and typically offer a low return as well, and they're considered somewhat short term compared to equity and the other avenues.
Okay, good enough. So debt has multiple avenues in itself. It starts off from the most basic thing, fixed deposit. Even fixed deposit is a debt investment. It would give you almost 6.75, 6.5 to 7.2, 7.25% returns per annum. Then you likely pointed out government securities. So government securities, there are 1 year government bonds as well as 30-year government bonds, which would ideally give you around 8.5% return per annum. And there are also company debentures or company bonds. Like for example, a lot of banks have bonds. Those would give you ideally around 9 to 10, 10 to 12%, depending on the risk. So companies that have a good debt standing, that have a good credit rating, will give you lesser return. They'll probably give you a 9% return. But companies that have a poor credit rating will give you 12%, 13% investment, 13% interest per annum, so that you are willing to take that risk. If the company defaults, you won't get the interest, but if the company does not default, you will be getting more returns compared to your other bonds that you have. So you can enter into a debt instrument either directly, like for example fixed deposits and bonds, both government as well as company bonds, you can enter it directly. Also there are mutual funds which concentrate on debt alone, so you can enter into debt through a mutual fund also. So if you guys like, I don't know if you guys know about mutual fund. uh, the engineer, I forgot, I didn't ask your name, I'm sorry. But so a mutual fund is something wherein, say a batch of 10 people come together and give them money to an entity, let's say XYZ. They give them money to XYZ. So XYZ, what he does is he takes all the money and invests it in the market, in probably bonds or probably in equity shares. And whatever returns he generates, like for example everyone, all 10 people gave 10 lakh rupees, he generates say 11 lakh rupees. So everyone will take back that 1 lakh rupees in return according to the amount they have contributed. And this XYZ will be charging a certain amount of fee. For example, 2 to 3% of whatever money is taken from the people. Next comes equity. So equity, by virtue of it, is one of the simplest simplest investment avenues available over there, but it is also as risky as it could get. So you can enter into equity by either directly buying shares from an exchange or probably through an IPO. So an IPO is an initial public offering wherein a company goes public. So when a company goes public, what I mean to say is a company which is a private company, for example, let's say Ola decides to list itself on the exchange, it will do an IPO. And before it goes onto the exchange, it will offer you shares to buy it. And once you've acquired shares from Ola itself, you can sell it on the exchange. Or you can enter into equity through mutual funds as well. Insurance. So insurance, by virtue of it, is actually more of a risk mitigation product than an investment product. But in India, it is very popularly used as an investment product as well. So in insurance, what happens is, like, as an investment, when we are talking about an insurance, for example, you pay a premium of say 1 lakh per year for 15 or 20 years, and you get back a higher amount, I guess around 10 crores or something. I'm not sure, like you can check out with insurance companies whatever schemes they have. So they have multiple schemes. You get payouts every year after 15 years, 20 years, or probably a lump sum amount. It depends on your age also. It depends on what is your need as well. So there are child education products also. So you keep investing as the child is born, and when the child turns 18, you get a lump sum amount so that you can use it for the college education and stuff. So insurance is also one of the investment avenues available in India. But insurance, when compared to debt and equity, it gives you lower return. So when I talk about giving 1 lakh per year and getting say 5 crores or 10 crores at the end of it, if you take into consideration the amount of time you've invested and amount of return you're getting, would be even lesser than a fixed deposit. But the concept over here is that you're saving, and that is what Indians, by virtue of their mindset, are satisfied with. You're saving money, and at the end of it, you're getting a lump sum amount. And also, investment as an asset, as a wealth management product, is not risky, because companies like LIC and UTI have been there. Sorry, not UTI, LIC and HDFC Life and say SBI Life and all those companies have been there since forever, and they won't run away with your money. That is how the Indian mentality works. Now, coming to real estate is something which is the most preferred investment avenue in India, because the Indian psychology says that you want to see your investment. You want to feel your investment. So if you have a land, you know that that land is yours. You want to feel it. You can stand on it. You can build on it. You can do whatever you want on it. But when it comes to equity, so people don't usually have that trust factor. That trust factor is kind of embedded in a person's psychology, which is missing in when it comes to equity, when it comes to debt, when it comes to insurance. People always think that uh, if someone takes my money, they'll run away with it. But with real estate, people are comfortable that my house is here, so it will remain here only. No one's going to run away with it. So real estate, it gives you more return compared to debt insurance, and it may or may not give you more return than equity. Usually in a long term scenario, equity will give you more return than real estate. But real estate, like I said, it is something like a physical investment, and the cost of real estate is high. Of course, like we know, it is not easy to purchase any piece of land or a house. It's going to cost you much more to enter into real estate than any of these avenues ever. But in the recent times, there have been some products that have been released called REITs, Real Estate Investment Trusts. So it is usually called as REITs as well. So REITs are nothing but is a form of a mutual fund itself, wherein people take your money and collectively, for example, you invest 1 lakh or 5 lakh rupees, and they take that money, they pool in that money, and they invest in land or probably other properties as well. And so this is one of the simplest ways into entering into real estate. And also the thing about real estate is that if you have invested in real estate, of course you can't exit it quickly. So for example, you have a fixed deposit, you can exit it as soon as possible and get your money. You may not get the return on it, but you'll have your principal amount back. But in case of real estate, it's hard to sell. It won't give you instant returns as soon as you want it. You may have to take a discount when you're exiting. Next category is gold and other precious commodities. So another favorite Indian investment is gold, of course, gold, silver. So in gold, you can enter physically by actually just buying gold, raw gold, or probably in the form of your precious ornaments as well. And there are gold mutual funds also out there, wherein you can invest into gold through a mutual fund, gold funds. And I think recently someone was mentioning, one of my friends, he told me like he invested into gold through Paytm. So apparently Paytm has come up with Paytm money or something similar, wherein they've opened up an investment channel. So he told me that he invested 5K or something into gold, and within a week it increased to 6.5. So gold, when we talk about as an investment, it is a safe haven. So whenever the equity markets are falling, people get scared and they want to move out the money from equities and put it to something much more secure. So when you're wanting to move your money to something much more secure, you would want to move it to a short-term investment only, because once the turmoil in the equity market is resumed, it's resolved, you would want to move it back to equity. So you can do it by either investing in debt, for example, a short-term government bond, but of course you can't go for a fixed deposit or a long-term bond. You can't do it in insurance, and of course you can't do it in real estate. So you can put your money in gold. So usually whenever you see the markets or equity markets are falling, gold prices will always go up. It is an inverse relationship between equity and gold always. And the last category is esoterics. So esoterics are something which are very talent oriented or probably an artistic oriented thing. Simple example of esoterics is paintings, artifacts, or say watches. So these things are something that not everyone will have a knowledge for, or not everyone will have any clue of. It's not easy to enter into esoterics because the audience for esoterics may not be vast. So not everyone knows, okay, this is a Da Vinci painting or probably a MF Hussain painting. They won't really appreciate it, but the person who will appreciate it will be willing to pay any amount of return for that particular piece of art or whatever it is, artifact. So in generally when you see in esoterics, the returns could be beating all of the categories combined together. There have been cases which wherein you've gotten 10,000% return as well within a year's time. It really depends on what the people are willing to pay for any given commodity. So are we clear on the investment avenues? Any doubts over here?
No, no, not no doubts.
Sorry, I could not hear you. Can you repeat?
No, no. I mean, I don't really have any doubts. Yeah.
Okay.
I had one doubt. Could you just shed a little bit more light upon REITs?
REITs, okay. So
Yeah.
like I explained the concept of mutual funds. So there are REITs, REITs, Real Estate Investment Trust. So similarly, you have probably a minimum investment size of 1 lakh rupees. You give your money to a real estate trust, they'll take money from you and they'll invest it in buying land. So when they buy this land, of course it's going to appreciate it with time. They may sell it to someone else as soon as in a year or something. So with time you will get return. But in a REIT, of course, like it's real estate, so you have to wait for a longer term for it to actually give you returns. It's not a short term instrument, it's a long term instrument itself. It just helps you to enter into real estate with a lower investment size. So you can't go and claim a piece of that land. For example, the trust buys a land in say Delhi near the airport, 100 acres, and you've contributed 1 lakh, which translates to almost say 1 acre of that land. So you can't go and individually claim that piece of 1 acre land that this is mine. You will have units of that fund. So how a mutual fund usually works out, similarly a REIT works out. You will have units of that fund and not a piece of that land or whatever property it is. Is it clear now?
Yeah, yeah.
Uh, I have a small doubt.
Yeah.
What about investing in cryptocurrencies right now? Like, I mean, I'm not quite familiar about that. So, is there anything which you could elaborate on that?
Okay. So cryptocurrency, to begin with, it is a form of currency, and currency is usually not looked at as a term, as a type of investment, because it's cash. At the end of the day, it is cash is not an investment. But when you talk about currency, weighing it against some other currency, it probably gives you some return on it. So for example, let's say USD. Right now, today USD reached a all-time high compared to the INR at 76.7 rupees per USD. So what happens is you may keep your money saved in terms of dollar or probably even a cryptocurrency like a Bitcoin or a Litecoin or a Ripple. And with time, it may go up or go down. So when you're talking about investment in currencies, it's again just keeping your money in form of some other form of currency. It is not ideally looked at as an investment asset. It's a cash asset. It is a liquid
Got it.
asset.
Got it.
Sin portfolio, an interesting
Um,
concept. Yeah.
I just had one last doubt. Could you just throw a little bit more light upon the risk factor of esoteric investments?
Okay, risk factor of esoteric investments. So esoterics is one of my favorite investment avenues. So recently there have been modern emergences of esoterics. For example, Rolex watches or probably other watches out there, and other luxury brands that are also out there. So what happens is that the risk over here is that you may not find a suitable buyer who will be willing to buy it at the price that you're quoting. So for example, if there is a watch that you've bought for say 3 lakh rupees and it is say limited edition, it is say a collaboration with another brand, say let's say Pepsi or a Coke. Rolex has come up with a Pepsi dial brand. So you like it, but it's not necessary that someone else may like it. But the person who will be liking it, he may be paying a extra amount of premium that you may not be getting in equity or real estate or gold. So what happens is in esoterics is the concept is simple over here. The demand may or may not increase, but the supply will always remain low. So in esoterics, for example, a person, a painter, has made a masterpiece of his own. So he won't be painting the same thing again. So the demand for that painting will be high, but supply is only one piece. So there are multiple people willing to pay. But the risk is over here. If you own a piece of art or piece of artifact, you may not find a suitable buyer who will be willing to pay that much amount for whatever you're quoting. But someone who appreciates that piece of art or artifact will be willing to pay even much more than what you're trying to expect also.
All right, all right.
One question here. So basically, equity is something that it is like an investment in a company share, right?
Yeah.
Okay.
Any other equity, you can enter into equity through, like I mentioned, mutual funds as well.
Okay.
Any other questions? Okay, sin portfolio. So anyone has any idea what is a sin good or a sin commodity? Anyone wants to give it a try? Sin commodity. Okay, so a sin commodity is something that does much more harm to the society than good. So for example, if I were to give you an example for it, let's just say cigarettes. Cigarettes are a commodity that are easily available out there, and they do more harm to a person or the society in large than they do good. But what happens is something like a cigarette or probably let's say alcohol, these companies exist out there. They are public companies as well. So what happens is when the morale of the public is low, they tend to smoke or drink even more. And when the morale of the public is high, they still tend to drink and smoke more in the mood of celebration. So when a time like this comes out, when, like, let's just say the current scenario wherein the morale of the public is low, people are sitting at home, they want to do something, so you end up smoking, you end up drinking. So things like these are always on the rise, no matter how bad or how good things are. So a company that deals with alcohol or cigarettes can only be facing a downfall when the government tries to bring in some regulation, or else it would always increase no matter what the scenario is. More industries or more products like these are, say, gambling is also a sin commodity or a sin service, I would say. And a lot of people even consider fast food as a sin commodity, because fast food also, it does more harm than it does good, but it still sells more when you're sad and more when you're even happy. And in international terms, in America, for example, wherein they have legal cannabis companies as well, cannabis is one of the leading sin company out there. So sin portfolio, when I talk about portfolio is nothing but a collection of all your investments. So sin portfolio, that translate to roughly an investment in multiple sin companies. So in this case, I've given a couple of examples over here. United Spirits. So as we know, Kingfisher, your McDowell, Signature, it is all owned by United Spirits. VST Industries, I'm unsure. This is a cigarette company. I'm unsure about the brands. I guess some local brands they have, like Chalmers, and they have multiple other tobacco products as well. You can't really consider ITC as a cigarette company over here, because ITC, they have a couple of cigarette brands, but their main business has now shifted to more of FMCG as well as hospitality. So there was a time when more than 50% of ITC's business was concentrated into just cigarettes, and that was the time when it was actually considered as a tobacco company. But now it is looked at as a conglomerate than a more of a conglomerate than a tobacco company, and it is no more classified as a cigarette company or a tobacco company for that matter. Delta Corp Limited. So if you go to Goa by any chance, there would be a chain of casinos called the Delton Casinos. So Delton as a brand is owned by Delta Corp Limited. It is also a public company. Jubilant Food Works. So anyone wants to take a shot as to which brand does Jubilant own?
Domino's.
Yeah, Domino's.
Yeah.
Any other brand?
I guess they. I'm not sure if they own French Loaf and Wang's Kitchen, but I remember seeing Jubilant Foodworks on their bills before.
Okay. So Jubilant Food, like you correctly mentioned, Domino's, and the second major brand that they have is Dunkin' Donuts. So it is always on the rise. Like Jubilant Food, personally, it's one of my favorite equity shares to be invested in. I have it in my portfolio since a long time, and it's given me touchwood really good returns. So these are the four companies you could look at if you're interested in building a SIN portfolio. If you look at how much return these companies have given over time, you would see almost an uptrend all the time. Very rarely do they actually go through a downtrend. And before we end today's session, this is a quote that I would finally like to give. Investing is half as technically complex as it's taught, but twice as emotionally difficult as it's assumed. So, what I was mentioning at the beginning, remember about greed. So, you may have a greed for 10,000, but you should also be able to afford to lose that 10,000. So when you see your money going down from 10,000 to it becomes 5,000, you should be emotionally be able to handle it. You should be emotionally be able to see it, because most of the times what will happen is you see your 10,000 becoming 5,000, you will want to exit it. You will be scared, but that's in the short term. In the long run, it will all be positive, but in the short run, it's gonna be always in the red and not never in the green. So it may seem very tough when you're trying to learn about it, and everything seems like haywire, like there are so many concepts and all. But trust me, it is half as tough as what you would be thinking about it as of now. It gets really hard when you see your money fall down. That is the time when you need to actually have a control over yourself, have a discipline over yourself. So that was today's session. I hope you guys enjoyed it. Any feedback?
It was
I really
great.
love the question. Yeah. For me, as a beginner, it is a lot of content that I gathered.
Okay. Any special areas like that you actually really liked?
I think the
Uh,
sin commodities area was something that we haven't really seen before.
Okay, good.
yeah. So as I mentioned, I actually have been investing in mutual funds for a while. But thing is, I've always been pretty apprehensive about investing in derivatives in the stock market, and it's fairly down to the fact that I haven't really been taken up on researching them to find out if it's actually worth my time. And I know it requires a lot of time commitment because of a lot of people preferring to intraday trading for profits and all that. But I guess I like the spirit with which you conducted this class, because now I'm sort of inclined to go check it out, and I maybe want to get into it. And I really liked the in the avenues you mentioned, the esoterics and the REATS, which I wasn't really as aware of earlier. So I'm not in a position to start investing in such avenues right now, but it's something that I think I will give it a shot in the future when I can do so.
That's great. So even if like, of course, you won't really go out there and buy a Da Vinci painting right now, but like you know about it now, like it's an investment avenue, and when someone next time mentions a esoteric, so you would know what you actually mean. Okay, so if you guys are interested in further learning, you can register for the course, for the workshop rather. You can also register for personal training as well. I'd be glad to take you through all the investment avenues and trading as well, including derivatives and also currencies, like someone mentioned, cryptocurrencies. I haven't really traded ever on cryptocurrencies, but I'm a very frequent trader on currencies in general, USD, GBP, Euro. Any more questions that we have?
One question that I would like to ask. So when it comes to sin commodities, due to the pandemic, will it be an effect on them? Because the Delta Corp Limited is something where like people don't really are not participating right now because of the pandemic or something like that.
Yeah.
So will there
So,
be any effect on it? Is the question.
okay, so good question. So right now, you see these four companies listed out. I would tell you very simply, United Spirits, it sells spirits or alcohol to put it out. So alcohol, sale of alcohol is not possible right now. No one's selling alcohol. So it will tend to go down because of course there is no revenue that is being generated for the company. But United Spirits, interestingly, what they did is they started manufacturing alcohol based hand sanitizers lately. So I was following United Spirits and they actually gave this one of their press statements that they've moved to manufacturing alcohol based hand sanitizers. So they are kind of diversifying their business for the given scenario. But that may not have that much of an impact on this company because you can't really expect to make much revenue out of hand sanitizers all of a sudden. That's not their primary business. Coming to VST Industries, which is essentially cigarettes, so right now we are looking at only conducting essential services, like business of only essential services, and cigarette by no means is an essential service. Cigarettes are not selling at the moment. So you can fairly expect this company to go down. Delta Corp, like you specifically asked, it's a gambling company. They own casinos. So casinos, again, like we know, casinos are not open for business right now. So you can expect the share of this company to go down. Jubilant Foodworks, on the other hand, is taking advantage of the market of the given scenario. They are delivering with taking safety precautions, as well as they've started to deliver essential commodities like atta and rice, and I think oil as well. They've started to deliver essential services, though. So they are taking advantage of the given scenario as well as continuing their business. They've been promoting their business to be safe and everything, but I think yesterday only there was a news that some pizza delivery guy got infected and 70 people were put into quarantine. So things like those will have an impact on the business. Right now is a very exceptional scenario. But let's just take us back to the 2008 2009 time, wherein the markets had fallen because of a debt crisis. So at that point of time, people were just genuinely sad. They could still access alcohol and cigarettes. So you could have expected a very high return on alcohol and cigarettes at that point of time. And say when the markets are at an all-time high, so that means people have more money. people have more money, they want to celebrate the money. So at that point also, alcohol, cigarettes, gambling, if people have more money, they would want to gamble it out. That's the basic assumption that you will have. So at that point, these companies will have more business. So every time a company's revenues tend to increase, their share price also tends to increase. If their revenues tend to fall, their share price would tend to fall as well.
So, but don't you think right now is a good time to invest in these companies then, considering now their revenues are dropping, the share prices are dropping, you can buy shares and then hold them, no?
I'm
Considering
on.
how it will
So
grow
so
later
what
on.
what I was explaining in this slide over here. So right now we are where you see WW2, the World War II. We are almost at that point right now. Like we could not possibly go further lower. Touch wood, hopefully. Let's just say we are at that point. So there's only one way, which is up. Like I mentioned, there are companies available at a discount right now, and it could not be a better time for you to start investing. And like you mentioned, these sin companies, alcohol companies. So when markets will go up again, people would be happy. They would want to celebrate. And of course, like alcohol is right now banned. You can't really buy alcohol, but as soon as the market opens up, people would want to suddenly buy more of alcohol, more of cigarettes because of their habits as such. So in the short run, suddenly these companies will have a boom in their revenue, and you can eventually expect a good return as well. Nice application of the knowledge you just gained.
All right.
Any more questions?
It was a really informative session. Thank you very much.
You're welcome. So with that, we'll be ending the session, assuming there are no more questions.
Uh, One last question that I would like to ask, because I am a beginner here. So, how do we really invest? Like, how do we contact the broker or something like that? Like,
Okay.
into the stuff.
So there are multiple brokers available out there. Major banks such as HDFC, Axis, ICICI, they have their own brokerage services, and then there are independent brokers such as Motilal, as well as relatively newer brokers called Sher Khan and also Zerodha. So what happens is these brokers, Zerodha is one of the biggest brokers in the country at the moment. One of the biggest. HDFC Securities is ideally the biggest broker in the country right now, but Zerodha is coming really close to HDFC Securities. So what Zerodha does is they charge you, I think, very low amount or a fixed 20 rupees per intraday trade or something. I'm not sure because I don't have an account with Zerodha.
It's $25 or I guess it was what 1 to 2% of your whichever is lower.
0.01, yeah, something
Yeah,
like that.
0.01. Yeah.
Yeah. So whichever is lower or something. Yeah. 20 rupees is the max cap and 0.01. So if your 0.01 of the investment amount goes up to 15 rupees, you'll be charged 15 rupees. So you can easily just download Zerodha's app from the Play Store or App Store. You can register, get your KYC done online itself. At the moment, they have online KYC, I'm guessing.
Yeah,
And
they do.
they do, right?
Yeah.
So and then you have to pay a fixed amount, I guess 200 rupees or something, to just register yourself. I'm not sure about it. Again, you can just go and check on the app itself, and you will be done. You will be up and ready to be started to investing within a week's time. I guess it would take even lesser than a week.
So, there is no minimum amount such in investing, right? Like any
No,
particular amount
no.
can be invested.
So I will tell you my story. So when I
Mhm.
was 18 years old, I started my demat account, and I did not frankly know any company. I had just heard Reliance and HDFC, and I had no clue about any company. So what I did is I was looking at the list of all the companies and their prices, and I don't remember, there was some company which was available for like 30 rupees. The shares were trading at 30 rupees. And being a complete amateur, complete unknown person to this entire concept of investing, I just picked up that share 30 rupees. I was like, okay, it's damn cheap. Let's just buy this. And I bought, I guess, 10 shares at 300 rupees in total. And then I picked up a couple of shares like this, just looking at whatever was cheaper. I did not really invest in Reliance because it was trading at 600 or something, and right now it's around 1200, 1100. So I picked up shares like that, and then they started going up. Some of them went up, some of them went down, and then I started to learn. Okay, it's not the cheapest share; it's about what the company actually does, what is actually going on with the company. So you can just start off by investing into any random company which you've heard about. Let's say you've remotely heard about ITC or say Tata Motors or something like that, or let's just say Jubilant Foodworks or these companies that are on your screen right now. You can just put your money, save 1,000, 2,000 rupees, and just track them over time and see what is happening. See, probably Google every day United Spirits or Jubilant Foodworks. You'll see a couple of news items out there which relate to the company, and decide what is this news. Is it positive towards the company? Is it going to be increasing the company's revenues, or is it going to be a decrease in the company's revenues? So the only way to actually learn, is by putting your money on the line and losing a couple of bucks and then feeling the pain of it, and then actually making sure that you don't repeat the same mistakes again.
Okay.
Any more?
Thank you so much for the session today. It was really informative.
Yeah, thank you guys for being interactive. It was fun to interact. It was fun to solve all your queries. I hope I was able to solve them. Thank you.
I really
And
like the examples that you've given through the session, man. It's pretty good. Without examples, typically these tend to just go over our head, but with examples, I guess it's a lot better in understanding what you mean.
thank you, man. So these are my contact details as well. If you feel like having any queries at any given point of time, feel free to drop me a text or a mail. I would be happily answering your query. I guess then that would be it for today. And if you guys are interested, you can enroll for the further workshop.
Thank
All
you very
right.
much. Yeah.
Yeah. Thank you.
Thank you.